You can follow us on Twitter at MarketFoolery is our Twitter handle. You can also email us. MarketFoolery@fool.com is our email address. Question from Christian Kelly, who writes, I know Kinder Morgan is really volatile right now, but is it still a worthwhile company to invest in? It looks cheap, but I don't know. And this question came in a couple of days ago. Kinder Morgan's even cheaper today. It's down about 7% today. One analyst out there saying the best way for them to fund CapEx is cutting their dividend.
And yeah, it seems like that's kind of priced in a little bit, not completely cutting it down to zero, but right now I think it's yielding about 12%, which is astronomically high for this company.
Right.
I think the shares are at an all-time low, or right around near an all-time low, and a lot of uncertainty around the dividend. Moody's downgraded its outlook from stable to negative because they upped their acquisition to 50% of Natural Gas Pipeline Company of America, which is a very debt-laden company with Brookfield and Infrastructure Partners, and so Moody's thinking in the future they're going to need to somehow recapitalize that company, and right now if they take on any more debt, they'll be dropped to junk bond status. It's a level that they've never been at, and so I think that this company is ahead of the game long term. In December of last year, they bought themselves, out of an MLP structure, which I think was a wise move with looming higher interest rates because they thrive on debt to grow as an MLP. So they're no longer as exposed to higher interest rates, but they still are very debt heavy. So I think that if you're a long-term investor, this is a company that you might never see at this price again. It could still fall a little bit lower just because of oil prices, but long-term, their assets just, I'm personally been considering over the last week or so. It's a recommendation in Pro Canada and multiple U.S. services as well. So it's a company that a lot of fools believe in, and it looks like an incredible bargain today. You might still see a dividend cut. So if you invest today, maybe shares sell off on that news, but long term, that could be a great thing for this company.
Well, and it's a great point because it does make sense when if you are able to set aside any emotion, any passion, and you just lay out the numbers. Yes, cutting the dividend to fund CapEx, that makes sense. But to your point, I would happily bet a dozen donuts that if they announce they're going to cut their dividend down to a penny, which is what this one analyst is suggesting, that there will absolutely be a sell-off because it's never a good thing.
Right.
It is. I mean, it may be a good thing in the long run, but it is, I would say, across the board taken as a red flag when any company comes out and says, oh, by the way, we're cutting our dividend.
And this isn't a speculative dividend payer. This was a stalwart dividend player in the energy sector. They grew it at 10% this year, or around 10 to 14%, which was lower than they had projected. They lowered their guidance down to 6 to 10% dividend growth. But a lot of analysts say that is extremely unlikely. Flat dividend is the best possible scenario because they're not going to issue equity to fund any more growth because the shares are so low. They can't necessarily use debt because they'll lose their investment grade rating. So cutting the dividend would be the only excess source of capital outside of their cash flows, which look like a break even for a 2016 dividend payment.